Bum 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 bum. All right, let's go.
The federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year.
Unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between a half and three-quarters, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? I'm just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions, and if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Howard.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there. They can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that to your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the longstanding thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past
Yeah.
about.
So there'll be an offset.
Offsets, yeah.
So that's true. We have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening, not much of it happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision-making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%, and I think it's important that we do that. Very important.
Nick.
Nick Timmeros, The Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months a year to go through the system, and we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system, so that goods inflation will return closer to what it's always been. I mean, it used to be for many years it was negative, and then the year before tariffs came in, it was 0, and it's running at like 2% now. So. And so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates, or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is continued. What we want to see for this year, rather, is continued progress on housing services. Finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation. CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%. And we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now, that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, we look at that, we see it, we get it, and I mean, everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless, it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
We did go through a long period where the shocks were all demand shocks, and so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years, for sure. And it's just a very different thing, and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but I guess, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Mike,
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility, rather, that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case. And of course, we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business services as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's, 1 percentage point above that. So calling that stagflation, it's not, I would reserve the term stagflation for, a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth.
Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting, and we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just, I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023, when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think that the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is, our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history, and then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year? No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction. And so I just think we do it. And, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Brian.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way. Everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet, and it will take some years of positive, real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed, and there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive, and that's just catching up really from inflationary pressures that take a while to get to into the price. So We take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing. And you know, what it does for us is, you know, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs, and you know, stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States anywhere in the world, in a market economy, in a democracy, and you'll see, you know, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or a specific answer on the first question. You know, we're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. You know, in terms of diesel prices, so your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, you know, the cost of food and other goods that really rely on it to
so
move
I think
across the country.
It's a more general concern than that. It's diesel prices, because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real, and they're material. So we are aware of that, and we're watching it. But you know, we're right at the beginning of this, and we don't know how big we just don't know how big this will be and how long it lasts. You know, it may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. You know, we actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of, you know, generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare, and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well, to finish up, you hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side, and I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
All right. Everyone's doing well. I don't know how long we'll be here, but we'll be here for a little bit. Let me fix this real quick. Give me a sec, boys. Give me a second. Dan. Let's go there. It should be perfect. Yay, we're good. Okay, so basically exactly how I thought the meeting was going to go. Nothing really shifted or changed, to be totally honest, for me. So, yay, that's kind of exactly how we drew it up. Bro, WTF, what does that mean? What are you talking about? Bro, I need help making money. I need food. Get a job. Get a good job. Go to work. You got this, brother. Not what they want. Hey, I don't tell people what they want to hear. Just what they need to hear. You're welcome. Real quick. Sorry, no. A few of the stream stuff's messed up. All right, so a few things that we've been working on. Past few days. Yeah, so I announced a few different things. So number one, if you're in Discord, so we have a new tool enabled. You have to be on the premium plan. Womp womp, let you know right now. It might be messing up because I had to fix the DMs as well. Let me make sure. Tesla calls. We'll do, what is today? We'll do 320 for Friday. It might be messing up. I have to go in and adjust it. I'll go in there in a sec. Okay. But the other thing that we're working on too is, and I kind of posted it earlier in Discord, is the new tool right here. I'm going to get rid of everything and get rid of all of our drawings. So again, we're slowly integrating this right now. It should be available for Discord. You'll just connect from your WAP and stuff. But anyways, you're going to get all the key levels now. We're working that in literally as we speak. So like if I could bring the drawings up, you'll actually be able to see it's literally right on top 394. All the other levels in here as well. We also highlight previous day low, previous day highs. It'll also give you confirmation when you go in here too. If you go like to the 1 minute, you can see maybe a better view, but it's going to give you reactions based off of your time frame. So be careful. So like here on the 1 minute, you can see the retest there, confirm there. Go to the 5 minute. Again, that's really what you wanted to see, the break and retest there as well. So again, you get to see all that. Next target T1, it'll automatically do T2. Go to another example like Apple here as well. Again, I don't know all the stocks we have in yet, but we've been kind of grinding through them. So yeah, Apple has it here as well. Again, you literally just go into your chart and it's all there for you. So you can actually see this is yesterday, break and retest kind of confirmed right there. You start breaking back below there. You can actually see what's happening there. 254. This was a better look on today. Retest, got back below, bam, dropped way down to our next level. And also could every next target down there. After you get the break and retest of another level, it just adds your new T1 and T2. If you have levels close to each other, it combines them into a zone, which we're also working on that as well to maybe have more zones overall for our levels. So some people don't get hyper aggressive, but do what you want to do. So again, just a few of the things that we're working on right now. But yeah, so pretty cool. Been doing a lot of this stuff on the back end. I can answer a few questions on equities if you guys have any questions. I don't mind. Just let me know. How am I feeling? I mean, the meeting went exactly kind of like I thought. Honestly, maybe more bearish than I thought, to be honest. Yeah, probably more bearish than I thought, to be honest. Sorry, this is an API issue on my end. I'm trying to. Oh, cool. There it goes. Yeah, it was pretty easy to fix. So yeah, all you do, so if you're in Discord now, again, I posted the video in Tyler's Zone so you guys can see, but a lot of times we get questions about like which stocks or like what option contract we should trade. And, like I don't just tell people to buy X, Y, and Z option. It's all for you guys. So like an example here, let's see like a Tesla, it's like for a day trade. So you go to just trade, you do a ticker or do Tesla. We're going to go puts because we're bearish, but puts, and then expiration. So I would do weekly expirations, bare minimum. But I'll do next week's here. Next week is the 27th, next Friday. You can do any expiration, doesn't matter, it'll pick it up. But yeah, you just got to make sure there's an actual expiration. You go into it, you click it. So then the cool thing here, now that we've kind of integrated, so it'll say it's top pick, just based off of our system and AI. It'll show you here gamma, theta, etc. And it'll say balance, whatever is happening there. It'll also tell you if Tesla drops $1 because you have puts. Contracts are subject to go around $49 to $50. If the Greeks stay the same, if they drop quicker, obviously IV could rise and that can become even more money. But overall, what to expect gives you liquidity as far as volume, open interest. Then you go in down here and it'll show you more information regarding other positions: 395, 400, 380, aggressive. Gives you a better detailed look at each one of those. But then also goes into per $1 move, what to expect. Again, subject to change. But yeah, so. Yeah, hopefully you guys like that. Shows you the delta, everything there as well. So pretty legit. Can't complain. Can't complain. Yeah, you're dropping right now on NQ. So the only thing that's going to be an issue too on this, I'm just letting you guys know ahead of time, is going to be like NASDAQ and ES. Those are going to have issues just because of like contract rollovers. So like we would have to go in there and adjust those pretty like, I guess once a quarter, I guess. But yeah, so like these are levels from like the previous quarter, so that's why they are an issue. So yeah, but anyways, pretty cool. Everything, it should work on everything else like QQQ, SPY. I mean, those are consistent as you can see here. So like again, key level here is 603 roughly. Retest, break, retest, back to the downside. Had a break and retest to the upside. Went to your previous day high there, came back down. So again, pretty clean. The amount of puts on those names is ridiculous. On what? Tesla? So, pretty interesting. But, yeah, so sometimes in Discord, people are like, oh, you're not really taking, like today, I pretty much did nothing today in Discord. Like, I wasn't going to trade pre-FOMC. Yeah, I mean, honestly, the only thing I would have traded is futures with the levels. But yeah, so anyways. But you're coming down further here on NQ. I mean, honestly, you have room down to like 24.6 flat. Get rid of the key level indicator here for NQ. Go to the daily. Yeah, I mean, I would expect you start coming down 24.6. Keep breaking down here. You got to put those in on the private credit names. Look above, message above. Well, yeah, credit in general is getting destroyed. Anything regarding like financials is getting hit, like COF, Capital One, AXP, American Express. You said APO is another name you mentioned. I don't know what APO is, but actually bouncing kind of decent, looking halfway solid. But yeah, so yeah, credit names in general are getting smacked. AXP looks like it wants to go down more. Another interesting name as far as downside, you're already getting pretty beat up, is Adobe. So I would be really paying attention to what's going on right now with Adobe. Now, number one, it's hilarious. Michael Burry went long up here, which I think I made a post pretty quick after that happened. I know I did actually. I know for a fact. I post so much on X, so you guys can go. Oh, right here. This was it. Yeah. I literally was bearish here. You can go watch the video. I posted it on March 12th. the Adobe video. Yeah, so you came into 270, as you can see your levels here, came into 277, went a little bit higher, but ultimately topped out 280, dropped all the way back down to 248. Again, this comes off the news of what Google just announced with Google Stitch, which is basically just another competitor for Adobe Figma. So yeah, honestly, Adobe looks terrible. Honestly, I think Adobe, there's a large chance Adobe flattens out, and this shit comes down like towards $200. I think there's a real like potential chance for that. Just took Adobe puts September 2018. Yeah, I mean, this is the level I'd be watching right here. October 2018, September. Yeah, same level. That rejection was nasty after earnings. Yeah. So, anyways, so definitely be watching that. Someone was mentioning AVGO earlier. I like AVGO, interesting, but again, the big level here is that previous all-time high right here from 2025 in August, and then you kind of gapped above it. That's your main level here. You go to the 2 hour, the 1 hour, you can really see. Like yesterday, this was the only trade I took yesterday, I think. Yeah, it was yesterday. I don't know if it was, I get my Mondays and Tuesdays confused. But again, mention this out in Discord as well. You know, getting below 323, break and retested 200, you shot straight down, you bounced off of it. You literally were holding, now flipping. So this could be pretty gross. I'm not going to lie. Next level would be down to 307, 308. But yeah, you might find more increased selling on AVGO now that you're confidently below the 200 SMA. You do have micro earnings in the after hours, so I'd be paying attention to that for sure. I'd be paying close attention to that. IWM. IWM supports right here. All you gotta do is zoom out for IWM. I'm not being like sarcastic. I would just zoom out. Again, higher time frames, daily 2021 highs, 2024 highs. So I mean, you're just looking for the retest, which you're getting almost right now, and your 200 daily moving average. So yeah, you're just looking at the simple levels there. Are we below 200 SMA on QQQ as well? What do you mean? Just go look at it. Go to QQQ, just type it in. Again, if you want to see all 200 SMAs written out, you go to SMA. Let's just look at it here. Go to settings, type in SMA on trading view. What the hell is it? What's that? There you go. I don't know why it wasn't popping up. Length, set it to 200. Scroll down, set it to the daily, 1 day. That's all you got to do. That's your 200 SMA. There's no overthinking it. Thoughts on Apple? It's pretty weak. I mentioned this on X. I know I mentioned it in Discord too a few days ago too. Yeah. So type in Apple. Yeah, so I mentioned it back here on the 12th. I mentioned it for sure on X as well, but I had more of a deep dive here. Yeah, so on the 9th, actually, I'm sorry, right there. So yeah, going to be watching Apple closely here. We start to flip 255. This is room down to 244 to 245 to 200 MA. Pretty big support. Could get ugly if you start losing it. The break and retest underneath 255, 256. So yeah, you broke, you retested, you're just pushing down to the 200 SMA now. So pretty simple looks. Not a lot of liquidity in there either. You try to get back above 255, they just couldn't hold it. So pretty clean. I actually need to make some videos for Twitter today. I haven't done anything yet. I was really waiting for FOMC. Yeah, so that's another thing too in Discord that I've kind of like, I got in a big, I kind of got like, well, we're in the process of kind of like not reworking Discord, but we're definitely changing the landscape. So a lot of people, I was guilty, and I have been guilty of, I feel bad like if I'm not posting enough. Like today I didn't do anything. All I did was work on like other stuff for like the indicator, the contract bot that we have now, which is dope. But like I just work on other things like that. And then like also look at long-term plays I'm looking to buy, but like anyways, and I've said it a lot that like where you're going to make most of your money is the longer term trades, the longer term swing setups. Like that's where the real money is in options. Like if you want to day trade scalp, like the futures, that's where you're going to make your money there. Like it's consistently at least, right? So yeah. And I think that I haven't been focused enough in Discord of like outlining longer term setups, longer term plays, etc. So yeah, another thing that's probably going to be changing here pretty soon is something like, let me see. I don't want to. Yeah, so I'm probably going to change Discord. This isn't like a test server that I run everything on right now. Like this. So our longer term set, it'll only be for longer term setups. It'll be a channel just like this. So it'll show active, I'm looking to add, looking what stocks I'm watching, which stocks I'm looking to trim. Am I completely closing them? So it'll be more like this as far as the long-term setups. So anyways, that'll be nice. Some people will use it, some people won't. But I think this just lets me organize stuff. And then also too, I want to get back in the habit of posting those videos for like different, like more in-depth setups as well. Which I think are pretty helpful. Like for instance, with oil, like that's how everyone traded oil is I made a longer term video, broke it down. So yeah. And again, the goal too isn't like, I don't want people just to be like relying on us. Like, oh my God, if Tyler took a vacation day, I can't trade today. Right. I really want to have more of it. Like number one, you're learning exactly what and why I'm looking at things. If you want to, it's there. You can go through, or you can just go down to like, hey, this is what Tyler got, etc. But yeah, I want to make it more to where it's not just like reliant on me and Jordan, right? So we're like, if you need us, we're there. But like ultimately, you know what I mean? Like that's the goal. Like, God forbid me and Jordan get in a plane crash, going down the Dominican Republic. You guys, oh, thank God Tyler had everything set up for us, right? So that's the goal. So anyways. But Apple looks like it's about to get fucking hit right here, right now. Oil still looks amazing. It's another big look right now. Oil still looks great. And it's funny how you're reacting to that level here on oil, like $95. Like, dude, people keep like tagging me and stuff. Like oil looks bad. Someone was saying like oil, like the market doesn't care. I'll be the doctor in 45 days. I don't know what that means. So yeah. And then this is all like, we're going to have different stuff coming out too. So again, whatever. So we've been super, besides learning a lot, I appreciate you take less, but more quality trades. That's the goal. Yeah. Dominican Republic. I was like, what are you talking about? Anyways, and then obviously too, like we've been working on a lot. I kind of like, I'm not upset, but I hate that we're dropping everything at the same time. But we are, so it is what it is. So the new website and everything should be done very, very soon also for you guys. So basically you're gonna be able to have, and you'll also be able to have your, specifically if you want to just pay for the trade, like the new setup we're gonna have. Jay doesn't want me to talk about the name. I don't really know why, but I don't think it really matters. So anyways, but we'll have all that there for you too. So you're gonna be able to go into your account, into journaling all your trades. You're gonna be able to go through literally everything. So if you want to go into pre-trade planner, you can literally go into your trade, look at exactly what you're doing, things along those lines. I want to see the ticker lookups also in here, which we're going to add more stuff into this. Type in SPY, shows you all the levels that we're looking at here as well inside here. You can go into options P&L, what you're doing there. Go into your analytics, which is probably the most important right now. We're really working on too for future stuff for you guys. We're really getting at more stuff on the prop firm side. We've been testing. Shout out to Chef in Discord. He's been awesome. So we're basically making it to where you can track everything. So like Chef is trading on Top Step, My Funded Futures, Take Profit Trader. I think he's in Lucid now. I don't know, right? So it literally all connects. So you can literally follow all of your data across all the platforms, show you what's working, your payouts, things like that. So this should all be available pretty soon. Jordan's been going crazy on this, so shout out to Jordan. But anyways, this is all stuff that's going to be added just directly to your membership if you're already a member of option drops of the newest. Like, so if you're like grandfathered in from like fucking 2022 paying $9 or $20, sorry, you're not going to get access to it. Like, there's a lot of cost that goes into this as far as like paying for paying for all the APIs, paying for the servers that we have to run this on, paying for a live action data as well. Because you're also going to have like a help. I think we're going to have our own AI on the website as well. So if you have questions, you can just do that as well. So yeah. Yeah, so you'll be able to go into your accounts and create other ones. So like this would be for Thinkorswim. Then you'd go in here, you can do Top Step, go for futures, and you can actually do exactly this is your obviously Trade-Evate, things like that. So you can connect all that as well to it. So it's all going to be literally connected. Starting balance, what you're at, 0. I would, for futures, I'd always just do 0. I wouldn't do like 150K and then change the color, things along those lines. It's pretty detailed. Goes to your win rate. You can it goes into all of it. Oh yeah, sorry. So here, my shit zoomed in. Okay, so this is an example. So yeah, you can do different. It's more along the lines of analyzing your trading, not just like, hey, what's the best stock to trade? Things like that. So important to know that. Basically going over your data. So yeah, hopefully that makes sense. But anyways, so pretty cool. It'll all be like added on to basically everything people are doing. And then we won't, I'm telling you right now, later on, me and Jay will do it. But for right now, it's not going to be an option. The key levels indicator, we might eventually like just sell that separately if someone wants it. For right now, we're not going to. Just letting you guys know, it'll only be like available with the membership. So we might eventually add it in later, but yeah. But Trade Deck will be available later on pretty soon when that releases. So you can just get that if you want. It'll be like kind of cheap. So yeah. So we pay, just close the deal. We pay more for losing trades and getting info. You see, I appreciate it, man. I never try to sell. I'm just like, I am excited about the stuff that we've been working on. You know what I mean? Like, and again, I know you guys know we've been working on this stuff for a while. So I mean, like there's days that we're really not like posting a lot of trades. But again, like the only time we're not posting trades is if we just don't like the setups. I mean, simple as that. But the other part of that too is like, if we're not working there, then we're working on this stuff on the back end. Like manually going in and having every single level in there. And then thinking of also new ideas as far as like creating it into the indicator as well. While also making sure it's not butt ass ugly, which is, kind of a challenge. So anyways, but yeah, something to consider. And then we'll also be adding in, so this is actually awesome. So sometimes me and Jay's levels can be a little bit different. Want to highlight that right now. So like you can see this level here, this main level 317, right? So Jay has been importing all these. So you can actually see that Jay already had that level imported right there, which was that previous high. So super easy level to mark out. 324, 200 SMA makes logical sense. 331, big level there as well. Again, you can see where that level comes from as well there. You go back to the upside. 356, give or take. Yeah. Another thing I do want to add in though is adding in more zones for this. Give you like maybe like 0.1% and make that a box. So this is your midpoint, then 0.1% to the down, 0.1% to the upside. More wiggle room for people. Because I do think some people will be like, okay, well, it has to hit the level exactly. I'm like, dude, levels are awesome. But sometimes can't be perfect, right? But anyways, if you guys have any questions, we'll answer some questions. So, and then there's even more to it too. This is like, I turned some of it off so you guys can see. So you'll be able to go in. So if you just double click the indicator. So, and this also helps out too, like the stop. So like if you get a confirmation, I would recommend 5 minute all points in time. But again, you get confirmation from there. It automatically will put your stop in. You can also adjust that if you want to, just for a visual, and you can look for your looking for. So like, where's your stops at? I was literally just looking at all of this before I got on here. Where is your stop? Okay, right here, stop loss cushion. So 0.1%, or yeah, you can change that to 0.2. Should change in a second. Yeah, I see it change right there. Went up a little bit higher, so you can see how that is there, right? Another thing you can go into that we've added in here as well. I turned it off, but so it'll do intraday swing highs and lows. Give it a second. Am I cooked, chat? Am I cooked? Did it not do it? Yeah, so you can actually see right there. So, okay, so it's showing you intraday 2, swing highs and lows. This is for today. So on the 1, going back into 319, then your lows down here, 315.7 is showing your level you should be watching there. You start flipping that, you're looking for continuation on the downside. So pretty clean stuff. I just didn't want too much shit on my chart right now. If I was just trading, I would keep it on. But like if I'm going over stuff, I don't want you guys seeing like 500 different lines. You know what I mean? It's kind of crazy. But yeah, thoughts on NQ to finish the day. You're below your 200 guys. If you're below your 200 SMA, I mean, it's pretty like, I'm not being sarcastic. You know, it is what it is. You're bearish under your 200. You are semi-bullish above your 200 MA right now. So breaking back below, flipping. I mean, you look pretty damn weak. You're just inching down towards lows again. Oil is also cranking back up. So no levels for oil. Love that. But at least it shows down there. So yeah, oil is a real problem here. I mean, Powell even said like that's the freaking issue. So anyways, but I mean, honestly, like you want to dip, man. Like you really do. Like if you don't, I don't know. Like I want to dip. I want us to dip aggressively. I haven't bought enough yet. I want to be buying more. So yeah. I still think AI infrastructure names are just gimmies. A good example is something I bought recently in Discord for the longer term. Started buying ETN around the 200 SMA. I think it was like right here, like 354, 355. It dipped. I should have bought more at 345. I had that key level marked out too. Goes way back, previous high there. But I mean, like holding up here looks so good. But anyways, I think AI infrastructure names are tried and true right now. Look at Net. I don't really like Nets. I don't think you're getting as good of a deal personally. I would rather go for something, especially like in cybersecurity. Names I'd be looking at for myself are not, and Snow isn't technically cybersecurity. More in the data end. I like Snow. I think Snow is going to be a beast. I don't think it's being priced in correctly here on Snow. It's personal opinion. You know, do what you got to do. But yeah, so I think Snow is a pretty decent deal. Could come down more, but as far as SaaS companies, I think it's a juicer. Raise the rates. We'll raise the rates. CRM's more aggressive. I would say CrowdStrike is another big winner. It's doing really well, already recovering pretty solid from those lows. So again, you absolutely love to see that recovering back to the upside. I think I would just be careful when it comes to SaaS names. Personally, I think they're the most at risk right now. Yeah, I think Adobe could get slaughtered here, to be totally honest. I mean, I'd be looking for you to drop down. Jordan has some levels in here you marked down 231, but I mean, honestly, I'm looking for, you know, what do they say? You know, we're looking for the kill shot, boys. We want the kill shot. Yeah, I think Adobe could get absolutely slaughtered. Truly. You even got a BRB off the level here that Jordan mentioned out here, so pretty interesting there as well. So yeah, I think Adobe could get, if you start seeing sell side in the market, some of these SaaS companies are really in trouble, but Adobe's in a bad spot. Basically, and I don't understand. Personally, I don't understand why Adobe's not signing deals with Claude and OpenAI. It makes no sense that they're trying to do this in-house, and that's a very stupid idea. It's a personal opinion, though. I think it's, you know, these companies are going to get eaten from AI, especially if they don't integrate directly with it. Because what's going to happen, and this is just important that people understand, what's going to happen is if you don't work with these other AIs and collaborate with them, you either have to do what Meta just did, which is buy Manus, and then you're obviously they have their like Llama is from Meta. They have their kind of shittier AI versions. I don't know. Zuckerberg's paying like an arm and a leg to hire these, you know, developers, and then they still have the shittiest AI, whatever. But then Zuckerberg just went out and was like, screw it, we'll buy Manus right now to, you know, fix some of the issues, and that works. That's not terrible, right? It's important to understand. So either you have to go acquire a really good, solid AI that's built around it, and, you know, integrate that into your system. But if you try to just build your own stuff, you're going to fail. And Larry Ellison from Oracle, I talked about this a while back. They already went into detail. Like, it doesn't really, his argument, if you guys didn't watch it, and I think Oracle's best high risk, high reward trade that exists right now. I'm telling you right now. But Microsoft is pretty solid for a Mag 7 name too. So, just food for thought. Basically how Larry Ellison broke it down. You have too many levels here, Jordan, not gonna lie. But it just goes back so much. So basically, and I would recommend just Googling this. Just Google, one sec, sorry, let me, so I can't see all the text. The sound you hear when your life savings you flush down the toilet. So I would recommend Googling Larry Ellison, data in AI. He talked about it like at an interview thing, right? And so he basically discussed like, it doesn't really matter that Gemini might be better than, or let's do ChatGPT in comparison to Claude, because those are the biggest names right now as far as like reasoning and coding. So it doesn't really matter that Codex is better necessarily than Claude right now at coding, because what's going to happen is no matter what, Claude's going to catch up to Codex in coding. That's going to happen just based on how they're being built, right? So all that really matters is the source in which these companies are bringing in data, because that's how these AIs are getting better and better. And all these companies right now are using essentially most of the same data. So where Facebook has an advantage is on the marketing side. They get tons and tons and tons of data from their marketing. It's Facebook ads, Instagram, Reels. It's endless amounts of data. And that all belongs to Meta. So they have a little bit of an edge there in that sense of it. Whereas, Google gets a lot of it from YouTube and Google search, which is also amazing, right? We all know this, right? So then you have to go back into something like OpenAI, which I assume they're getting a lot of their data from Microsoft and then other sources as well. I think OpenAI had a deal with Reddit, so they were collecting a lot of data from that. So these are all different ways in which they're grabbing data. So which companies are to perform better over time is going to really rely on the quality of data and private data that they're able to get that other companies don't have access to. So I want to make that like really clear. So the idea that right now that Meta is kind of like a shittier AI, which I'll say that, it will get to that tier eventually. It will get better, especially for what they're building on Manus for primarily ads and their algorithm for Reels and whatever else, right? So it's really important to understand that. I don't know where I was like going with that in the beginning, but anyways, very, very interesting argument. So when you're looking at this, I think data is one of the most important things across the board right now. And so, I was going back to Adobe. So like the idea of Adobe building these AIs in-house, and for some of these SaaS companies, it's mentally retarded. If you're a CEO or if you're someone running these companies and you're cheaping out instead of partnering, it's kind of retarded. It just is, because you have to understand too, this is a race as well. So if Adobe really falls behind in the long haul of this, as far as their product and simplicity to use and just overall quality of their product versus, for instance, Apple just acquired a new motions effect company that they're going to plug right into Final Cut Pro. I'd be willing to bet once they fully have whatever AI they're using that they're also going to implement that into Final Cut Pro. So these are also things you have to be considering what's like going on. And so if you get to this point where Adobe just starts falling off and people don't want to use it, and there's other companies that are already getting better and better and better, yeah, Adobe might eventually get better if they've, break down and partner or whatever. But you have to understand that discrepancy that they're doing and re-obtaining that customer is very difficult to do. That's another metric people don't think about. Not only the acquisition price per customer when it comes to marketing, but the reacquisition price of a customer is very, very difficult to do. Because if someone left your company or something, either number one, they were struggling for money, which you might be just out of their price range, which, that's a better solution because you can either offer, discounts or something like that. But if they left your product because it wasn't as good as another product, they're not going to want to come back. And you have to spend a lot of money to get them back. So I think that's the danger of what Adobe is doing. A good company you can see this with is something like Robinhood. Now, Robinhood, if you remember, and again, this is a total different sector, so I'll say that. But if we go look at Robinhood and you go back specifically to what happened with, taking the buy button away, right? And again, I think it's so stupid that everyone points the finger at Robinhood for taking the buy button away, but every other broker did it. Riddle me that, right? So anyways, they got just destroyed from basically this $34 base and went down to 10, $15, right? For 2 years. It was brutal from 2022 to 2024, right? But then they started pivoting and making that product better, and they spent a lot of money on advertising, and they kind of have really good organic marketing as well. But you didn't see that happen until they started really, number one, making the product unique, and then also spending a crap ton of money to get these customers back, right? And then now it's just once they got them back, now they're at an area where if you go look at their member growth has kind of stalled off on Robinhood. It's not continually going up. So now they're just focused on retaining members and saying look, we're going to keep adding new shit better and better and better, whether it's AI, it's, call sheet, things like that. They're just doing more and more and more. So they're keeping that customer and not even giving them the option to leave. So again, those are things you have to be thinking about right now, especially in the world of SaaS. I think SaaS is the most, I don't think people are going to come out and just steal the entire business models. I don't think that's going to happen. Hey, Claude, vibe code me Adobe Premiere, make no mistakes. I don't think that's going to happen. But if there's already companies like DaVinci Resolve, right, for instance, which is a kind of a cheap option, right? Final Cut Pro, and anything else is being developed. And, these companies are going hard. I'm just letting you know, Adobe's could be in trouble. This goes for other companies. This goes for SaaS like Duolingo, right? Can someone recreate it? Potentially, yeah. But the other part that should be concerned is how are they pivoting? How are they trying to, stay relevant? How are they, what's the plan for future guidance? I think SaaS companies, if they're not giving you a clear look at future guidance, how much money they're making, that's a red flag. Another thing on Adobe, they released this stupid statement. If you go look at it, they basically said their AI revenue has increased 3x over the past year. But then they don't give any information around those actual numbers. CRM, when they talked about Agentforce, which some people talk shit about it, doesn't matter because the numbers are what people care about. They released how much money they're making now per quarter and how much it's actually grown. The only reason why you wouldn't give out that information is if the number isn't really that impressive. And so again, as your SaaS companies, you are on offense right now. You have to be. You have to be on offense. So again, personal opinion, but something to be looking at. Another SaaS name that's interesting is Intuit, INTU. I would be watching this one as well. Monster support down here. You want to see back above 490. But again, what I'm looking at there. So hopefully that makes sense. I'm not trying to just be negative, but I'm also trying to give you guys an idea of what and why you should be looking for certain things in the market. And hopefully you don't get caught, right? You don't want to get caught stuck in a name that you don't really like. So anyways, yay. IGV has been hit pretty hard. This is also really important to understand. I think these are, you have to ask yourself I recommend when you're investing or you're looking to invest or you're looking to make a play, you should be, especially on swing trades, you should be and think from a devil's advocate point of view. Personal opinion. What's the reason IGV dropped, from November till now? Well, it's because there's an issue now and there's a realization that AI is enabling people to do, software's jobs very simply and very easy. There's a disconnect for how much I need to use certain things. A great example, I do not need to use Adobe Acrobat for anything. If I need a PDF made, I just send it to my open call agent, say, hey, this is the information, yada, yada, yada. I need to bill a sponsor, make this into a invoice, turn it into a PDF, send it back to me, and I'll email it out. I can even tell them to email it if I need them to. That's one example. There go down a laundry list of other examples, right? But something to think about, right? That wasn't there before. And now it's not just there, but it's very, very, very easy to do. And so the question here with SAS, IGV specifically, is, okay, well, you draw from here to here based on the improvements of AI. Well, again, and this isn't me being a doomer, right? I'm just trying to point to the facts of what's happening here. Well, what do you think is going to happen when these AI models are getting better and better and better? Elon Musk literally said the other day, go Google it. Don't listen to me. Google it. He said, we are officially, he believes, in a part of the singularity, which again, this gets really like far-fetched and a little nerdy. Do your own research, like I always say. But again, what the singularity is where you have AI models that are just building on top of each other. And each model will get quicker and quicker on the improvements. Very important to understand. So right now, it's important to understand too that Claude is the worst it's going to get right now. OpenAI, ChatGPT this is the worst it's going to be, right? It's only going to get better. So that goes back into the idea of, okay, if software companies are already hurting, what happens when a newer and better model comes out? What else can it replace? And these are the questions that are like churning at this point. Now, again, I think cybersecurity is probably the safest name out there or sector when it comes to SaaS. But again, just food for thought. Food for thought, food for thought. So. Fun stuff. But if IGV gets back above like 90, you look fine. Till then, I would be careful. I would be careful. Yeah, NASDAQ's getting BTA right now. Bell to freaking ass. Yeah, just going straight down. Next all I have is I said earlier like 24.6. I don't have a level there though. I mean, really looking back down 24.55. It's next big level. It's pretty weak right now though. What time is it? Oh, market's closing in a minute. So pretty bad. But anyways, I hope that makes sense. If you guys have any questions, ask right now because I'm about to head out. So yeah. Nothing. All right, guys, I'm gonna head out of here. Someone said, well, tomorrow will be a green day. Let me rub my balls, put some oil on them. One sec. Let's rub them. Let's find out. Okay. Nope. I don't know. It's not showing like tomorrow's gonna be a green day. Thank you for asking that very intellectual question. I needed that in my life. I don't see anything. No, I don't see any questions.